Stocks and companies tend to trade through cycles of expansion and cycles of maturation. But sometimes companies just fall off a map. And in today's video, we're going to take a look at 4 of those companies that have seen their stock prices plummet. A few of them are actually trading near their 52-week lows. So we're going to dive into these 4 companies, take a look at their current valuation, and look at whether I'm looking to buy them or at what price I would be willing to buy these companies at. But before we dive in, do me a huge favor. Click that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And I tend to do a bunch of videos going through stocks I like, but it's always important to vet that and look at it from a different perspective. So definitely check out The Motley Fool, where you can see their 10 best stocks to buy right now by going to fool.com/Mark. Check out the link down in the description below. All right, let's jump back into today's video, taking a look at 4 beaten down stocks, beginning with our first, which is Nike, stock ticker NKE. Just do it. That is the company's motto, but certainly hasn't been the stock motto because it's been just fall of late after the company has lacked innovation, which has shown up in their weak earnings results. Is this athletic brand falling out of style, or is this just a period they're going through and it's a turnaround story that's about to happen? As you can see here, shares of Nike currently trade with a market cap of $111 billion. However, that is down more than 30% in the past 12 months, with most of that coming in the past 6 months alone. Not only did this company report weaker than expected results, they also guided to weaker than expected forward guidance, which tells us this turnaround story isn't happening quite yet. However, the company is taking steps to right the ship, as they're bringing on a former tech executive into their newly created CIO role, or Chief Innovation Officer, to focus on innovation, direct-to-consumer, and online sales. So when I see a company that tumbles like this, and I see weaker than expected results for a number of quarters in a row, it definitely has me thinking. Not something I want to jump into all that quickly, but there is a story behind it. And when you look at the weakening US consumer, spending on Nike pulls back. Consumer discretionary spending is reduced. People don't necessarily have the funds to go buy a new wardrobe all the time or new shoes all the time. So it makes sense from that standpoint. In addition, China is a huge market when it comes to Nike, and that economy has been in complete disarray. Investors have loved the name in the past as it has been able to blend both solid share price growth and dividend growth together. As you can see here, the company currently pays a dividend that yields pretty much 2%. They have a 5-year dividend growth rate close to 11%, and they've been growing their dividend for 11 consecutive years. But as I like to say, never invest based on yield alone. Now let's take a look at valuation, where we can see that analysts expect the company to generate 2025 EPS of $3.14 per share, which is a 21% year-over-year decline. But earnings are expected to recover the following 2 years. So that is a positive if it takes place. This gives the company a forward PE multiple of 23.5 times, well below the company's 5-year average of 34.2 times. So you are getting a substantial discount in terms of valuation looking at this one metric as compared to its historical average, but this is one of those companies that's trading at a discount for a reason. On the more positive side, though, the company can fund this turnaround story as they have a very superb balance sheet and a AA- credit rating. So they do have some time to turn this around. There's no doubt in my mind that this stock could find lower lows, but if the stock fell to the mid $60 range or lower, it is then that I would step in to likely add it to my portfolio. Stock number 2 on our list is Starbucks Corporation, stock ticker SBUX. This is another global name here in the US. And another name that has a very loyal customer base, a customer base that continues to grow, as the company saw in the latest earnings report that their rewards active members has increased yet again. There's been a lot of competition in the coffee space, and Starbucks has always held that top spot. But there is one company that I see has been closing the gap, albeit slowly, and one that I'm excited to look at, and we'll probably do a video on here in the near future, and that is Dutch Brothers, stock ticker BROS. But today, we are taking a closer look at Starbucks, who currently has a market cap of $85 billion, and over the past 12 months, shares are down 26%, with 20% of that coming in the past 6 months alone. Similar to Nike, Starbucks has been dealing with a weakening US consumer, and not just here in the US, but in China as well, which is the company's second largest market. They had huge expansion plans going over the past few years. They got to a point in China where Starbucks was opening a new store something like every 9 hours or so on average. In addition to a weakening consumer, the company has seen higher input prices, higher wages as well, which has forced them to increase prices, which in result reduced traffic. Consumers at that point have pushed back on those higher prices for the time being at Starbucks. However, like Nike, Starbucks has been a dividend growth darling over the years. They currently yield a dividend of 2.9%. They have 9% dividend growth rate over the past 5 years and 13 consecutive years of dividend growth. There's actually quite a few similarities between the likes of Nike and Starbucks. They both rely heavily both on the US and the China market. We've seen a weakening consumer here in the US and a just terrible economy over in China. So we need a rebound over there before both of these companies are going to see some likely boosts. In terms of valuation, analysts are looking for the company to generate 2025 EPS of $4 per share, which equates to 13% growth after no growth in 2024. That gives the company a forward PE multiple of 18.7 times, well below the company's 5-year average of 31 times. Similar to Nike, I would look for a pullback here in the mid $60 range before I add to Starbucks. Now, this is a position I do, in fact, already own, so I'm going to be a little bit more patient here. But at an 18 times multiple, if it drops, say, another 10%, we're looking at a great valuation for a company that I definitely have a lot more confidence in a turnaround story. There's still going to be even more people drinking coffee 5 years from now. And that leads us to stock number 3, which is Domino's Pizza, stock ticker DPZ. It's pretty funny that the first 3 stocks that we've looked at so far are all consumer-facing companies, and they all have the same story, a weakening consumer. The thesis only strengthens, and we're looking at it from different angles. We're looking at it from athleisure, athletic wear. We're looking at it from a coffee, morning breakfast per se. And now we're looking at it on the dinner side of things, with the even cheaper side of things with Domino's Pizza. That is very different from the high-flying technology companies that are more business-facing, the NVIDIAs of the world, the Microsofts of the world. Domino's Pizza currently has a market cap of $15 billion, and over the past 12 months, the shares are actually up 6%. However, over the past month alone, shares have fallen roughly 20% for DPZ. What happened, you might ask? Well, the company missed revenue expectations by $10 million, which is a decent amount of pizzas. Global same-store sales grew 7.2%. US same-store sales grew 4.8%. So in reality, the earnings weren't all that terrible, as volumes actually increased, unlike Starbucks that saw traffic disappear. The biggest negative, though, was the fact that management suspended its expansion plans. However, from an efficiency standpoint, EBITDA margins have increased to its highest levels, as has operating margins, which I love to see. DPZ has also been a darling for dividend growth investors over the years, and they currently yield a dividend of 1.4%, but they have the strongest 5-year dividend growth rate at around 18%. Management has increased the dividend for 10 consecutive years and counting. In terms of valuation, analysts are looking for 2025 EPS of $17.76 per share, equating to 10% year-over-year growth. That equates to a forward PE multiple of 24 times, slightly below their 5-year average of 30 times. So you're getting a decent discount here. But with my concerns around the state of the US consumer, which is where the majority of the Domino's pizzas are located, I'm looking for probably at least another 10% drawdown before I consider shares of DPZ. And that leads us to the 4th stock on our list, which is a doozy, and that is CrowdStrike, stock ticker CRWD. This is one I've got a ton of questions on. And I'm not sure what happened when that global IT outage happened. Maybe they were having their intern roll out the latest update, but it impacted millions upon millions of consumers and businesses. This is a company where we can't go by traditional valuation and technical analysis standards. This is a company that has to rebuild their reputation, and a company where earnings moving forward are going to change drastically. The company currently has a market cap of $55 billion, and over the past 12 months, shares are up 35%. Even after all it has gone through, that speaks to how well this stock had been performing prior to that. However, shares are down nearly 45% from its 52-week high set in early July. This is a stock that I actually held in my portfolio into mid-June. However, because of valuation, I sold out of it. And what do they say? Sometimes you just get lucky. And again, this company has a lot to rebuild in terms of its reputation, and it's going to go through a ton of legal troubles. Delta is the most notable company who is already bringing legal action against the company, as they reported to have lost an estimated $350 to $500 million in that particular day alone due to the IT outage. The company is dealing with 176,000 refund or reimbursement requests after more than 7,000 flights were canceled. Insurance startup Parametrics estimated that CrowdStrike incident resulted in a total loss of $5.4 billion for Fortune 500 companies, not including Microsoft. Even the company's own shareholders have already brought a legal suit towards them. So a ton of reputation to be built here. And this is a company where, again, you can't use traditional valuation standards. And it's one where I'm not going to get caught with a falling knife. I would rather miss the bottom than catch that falling knife, which is why I don't want to take any position in this particular stock right now until things settle out. And it's going to take a few quarters or maybe even a year plus in order to smooth all of this out. So that there is my take on 4 stocks that have seen tremendous pullbacks in the recent months or over the course of the past 12 months. Down in the comments section below, let me know, of these 4, which would you buy at today's prices? And if you haven't done so yet, please hit that like button down below, subscribe to the channel, and we'll see you in the next one. Take care.